welcome back. You know what we did in this class is we just took a quiz. So let's show that on the screen if we could. There is the quiz that we just took, and for you folks at home, online students and everywhere else, why don't you just pause and see if you can do that quiz, and then just push play when you are ready to go. Okay? Let's go ahead and go over the answers to it. I really don't want to spend a lot of time on this. Luke, you did a nice job on yours. The first thing that you did was figure out the per units of 200, 156, and 44, right? And you just took these numbers divided by 2,300, correct? Then you calculated the contribution margin unit you'd already had done. The CM ratio is 44 divided by 200 from above, 22%. The break even is the fixed cost of 58,960 divided by this CM per unit of 44. And to get the break even in sales dollars, you could have taken the fixed cost divided by the CM ratio of 22%, or it looks like what you did is you just took the break even in units and took it times the sales price of 200. Either way, you get $268,000, okay? Then I asked you to restate this at an activity level of 1,200 units. Well, we just figured our break even is 1,340, so if I'm asking you to do it at an activity level of 1,200, we know that we're going to have a negative bottom line, correct? Okay? So all you did was put your per units there again, okay? Multiply these three numbers by 1,200 to get those three numbers. And your fixed cost stays the same from above, and thus you have a bottom line that is negative, 6,160. Okay? All right, you can come off that. Something like that should be very easy at this point, okay? Should be really easy to do at this point. So if you are not there with that, make sure you get going, okay? Because that should be pretty simple. Let's go through the homework now, all right? Let's go through the target profit handout first, okay? The target profit handout, okay? All right. You guys do that? Do you have any trouble with that? Not too bad. Okay, target profit handout. The following is information for Clinkscale Company, okay? Now I give you your totals, I give you the number of units, so I always like to write the per units over here to the side. 60,000 divided by 250 is it 240? 43200 divided by 250 is 17280. That minus that equals 6720. Is that correct? Or you could have taken 16,800 divided by 250 and gotten 6720. Let's go ahead and figure out our CM ratio, okay? CM ratio, we can either take that divided by that or that divided by that. Either way, I think it's a CM ratio of 28%. Is that correct? Okay. The CM per unit is 6720. The CM ratio, as I said, is 28%. How many units would Clinkscale have to sell to earn a desired target net income of 48384? Well, you just, let me zoom out a little bit. You just take your fixed costs of 14,784 plus the desired target income of 48384. 48384 divided by, what are they asking for? How many units? So we divided that by CM per unit, which is 6720. Okay, make sure you do your order of operations correctly. And that, I believe, equals, is that 940 units? 940 units. If we sell 940 units, our bottom line should be 48384. If you want some extra practice, recast a contribution margin income statement at that level and see if that is, in fact, the bottom line for this level of activity. Okay? How many dollar sales would it take for Clinkscale to earn a desired target income of 82,656? Here they're asking for sales dollars, right? Okay, so let's see if I can write it over here. that would be 14784 plus 82656. And we divide that by the CM ratio of 28% or 0.28. And I believe, do we get a nice clean number of $348,000?
Yep.
Okay, not too hard, is it? All right. Okay, questions on the top part? Okay, let's take a look at the bottom part about Hogan Inc. Hogan Inc. sells only one product with a selling price of $200 and a variable cost of $80 per unit. The company's monthly fixed expense is $60,000. The corporation would like to achieve a profit of $30,000 next year. Determine the units to be sold and the sales dollars necessary to achieve the target profit. Okay, well, we take $60,000 fixed costs plus the desired income of $30,000. We divide that by the CM per unit of 200 minus 80 equals 120. And that equals, is it 750 units? Okay. All right. For sales dollars, we take 60,000 plus 30,000. And we divide it by, what's the CM ratio? 80 divided by 200, 40%. Is that correct? No, I said that wrong. See, when I try to do a shortcut, that's what always happens. Sales is 200. Variable costs 80. CM is 120. Is that correct?
Yeah.
So your CM ratio is 120 divided by 200, which is what? 60%. Okay. So 90,000 divided by 0.60 is 150,000. And it would probably be a good idea to check your answer by just taking the number of units to achieve that income times the sales price of 200, and that also equals $150,000. Is that correct?
Mm-hmm.
All right, good deal. Any questions on the target profit handout? All righty. Let's take a look then at the Hudson Company handout. The Hudson Company handout. All right? Okay, take a look at that. Let me grab my notes here. All right. Hudson Company reports the CM income statement for 2015 below. Okay? Oh, I like to write everything over here, so let's go ahead and do that. Per unit is 225, 180, 45, is that correct?
Yes.
Okay. And what's our CM ratio?
20%.
45 divided by 225, which is what?
20%.
20%. Okay. All right. Compute the break even in both units and sales dollars. They're asking for number one. Okay. The answer to that is right there. We've done this a number of times. 7,200 units or $1.62 million. Is that correct? Did you guys get that? Okay, good. Number two, assume Hudson Company has a target pre-tax income of $162,000 for 2016. What amount of sales in dollars is needed to produce this target income? Okay, well, the answer to that is, did you get 2.43 million? Okay, fixed costs plus target income over the CM ratio, since we want dollar sales, and that equals 2.43 million. If our sales are 2.43 million, our bottom line will be 162,000. Cool? All right. It then goes on to ask, if Hudson achieves its target pre-tax income of 2016, what's its margin of safety in dollars and percent? Well, in dollars, it's $810,000, right? Which is just the expected sales, let's see, that we calculated above, 2.43 million, minus the break-even sales, which we also calculated earlier, right? So that's 810,000 margin of safety in dollars. We talked about margin of safety is really more helpful if it's in a percentage form. So we can take that $810,000, which again is the 2.43 million minus 1.62 million, divided by the expected sales of 2.43 million, and we get 33.3% margin of safety, which seems like a pretty good cushion, okay? And that might be something you want to calculate on a monthly or quarterly or annually basis to see if your margin of safety is going up or down, what you're comfortable with. Cool? Okay, any questions on number 1 or number 2? Let's go to the next one, okay? If the company raises its selling price to $240 per unit, compute its CM per unit, its CM ratio, its break-even in units, and its break-even in sales dollars. All right, let's do that. Okay. Well, this is what we get. It's pretty self-explanatory. Our new CM is $60. Our revised CM ratio is 25%. Our new break-even in units is 5,400 units. And our new break-even point in dollars is 1.296 million. Did you get that? Okay. Now, let me put up the original break-even information. See if I can put it on the same page. Okay. Now, this is the original break-even. 7,200 units, 1.62 million. If we undergo this course of action, then our break-even will be reduced from 7,200 units to 5,400 units. And it will be reduced from 1.62 million to 1.296 million if we undergo this change. Okay, so my question is this. You can come off that. Do we undergo that change? Do we do that?
Yeah.
Why?
Because it makes it so you have to produce less units to have a better profit.
Well, you said that almost right. You said produce, sell, right? Okay. Okay, that's kind of a little bit of a trick, okay? Because I always ask that and students say, yes, you should do that. Because, let's look at the screen again. It lowers your break even from 7,200 units to 5,400 units, or from 1.62 million to 1.296 million, right? And that's basically what you said, Jeremiah, right? Okay, but I want you to understand the fallacy of that. Just because we can lower our break even doesn't necessarily mean that's a desired course of action. Take a look back at the screen. What if I raise my selling price to $1,000 per unit? $1,000 per unit. Man, our break even will really go down, right? So should we do that? You see what I'm getting at? Okay? Just because you can do something to lower your break even doesn't necessarily mean that you should do it. And I took it to the point of ridiculous. Why not raise my selling price to $10,000 per unit? I only have to sell a couple of these things, a very small number. But nobody will buy them, right? So, by itself, the fact that a course of action lowers the break even does not necessarily mean we should do that. Make sense? There's other factors involved. But I know it's easy to initially think that. But just be careful, okay? All right, let's go to the next question. Number 4. Now, this is different. This is a different question, all right? The marketing manager believes that increasing advertising costs by $81,000, not to $81,000, but by $81,000 in 2016 will increase the company's sales volume to 11,000 units. Prepare a forecasted CM income statement for 2016, assuming a company incurs the additional advertising costs. Okay? Well, let's take a look at that. Let's take a look at that. Hold on one second. This is our answer. Okay? Our new, let's do our per units over here. Our new per unit is, well, this stays at 225, doesn't it? Okay. And this actually stays at 180, doesn't it? And so this stays at 45. Is that correct? Yeah. But now our fixed costs go from, let's see if we can actually show the original as well. The original is on top. They go from 324, they increase by 81,000 to be 405,000. Now, our sales volume increased, did it not? Is that correct? It said it would increase from 9,600 units, or estimated that it would increase from 9,600 units to 11,000 units, correct? So that's our new activity level. So, first of all, did you get this contribution margin income statement? Okay, secondly, should we do this course of action? Here's the choices. Yes, no, or it's like break even, we just can't say.
No.
It's definitely no. And why is that, Henry?
Because it doesn't, the additional units don't cover the cost of the advertising.
Right. The additional costs don't, the increase in sales volume is not sufficient to offset the additional costs. Or said another way, would you rather have a bottom line of 108,000 or 90,000? You see what I'm saying? Well, I'd rather have 108,000, correct? So if their estimates are correct, we should not do that course of action. Make sense? Okay. Now that's just kind of dipping our toe into sensitivity analysis. All right? If you take managerial accounting from me, we will dive in a lot deeper. Okay? But these are really good things to know if you're going to be a manager of a business. Okay? All right? Okay, we have one more I think I signed, which was Quick Study 2111. Is that correct? Oops, a little too much zoom there, Texas. Okay, a high proportion of A company's total costs are variable with respect to units sold. A high proportion of company B's total costs are fixed with respect to units sold. Which company is likely to have a higher degree of operating leverage? What'd you come up with?
Company B.
Company B will have higher operating leverage. Okay? Let's analyze why that is so. Okay? Well, first of all, let's remind ourselves that there's sales minus variable costs equals CM, minus your fixed cost equals net income, right? Okay, how do we calculate degree of operating leverage? What does that equal, remember?
Total contribution margin divided by pre-tax income.
CM divided by net income, okay? I used to never remember if it was CM divided by net income or net income divided by CM. So the trick I came up with is just lay that across there, and there's the formula. CM divided by net income. Isn't that great? Boy, that's wise. Okay, so your degree of operating leverage is your CM divided by your net income. Now, understand that if you have a lot of fixed costs, then a large amount will be subtracted from this, and this number will be a lot higher than that number, correct? This number will be a lot higher than this number, so that would give you high amount of operating leverage, wouldn't it? Does that make sense? Okay, now let's talk a little bit more about operating leverage. Let's say we have a seesaw here, And let's say our seesaw is like that, okay? This is from physics, okay? So the seesaw goes like this, okay? Bonus question. Does anybody remember from physics what that is called right there?
Fulcrum.
The fulcrum. Very nice. Very nice, Matthew. Okay? That's the fulcrum. Okay. Now I want you to understand that degree of operating leverage is a little bit, if I move this side of the seesaw a little bit, this side will move a lot more. Is that correct? Okay. That's kind of like operating leverage in a business where a little increase in sales can cause a larger increase in net income, especially when there's a lot of fixed costs. Okay? Now, think of it this way. If you have a lot of fixed costs, your ride is going to be a lot wilder, both up and down, than if you have a lot of variable costs. Good times will be really good, bad times could be really bad. You with me? Okay, let me put it in another way. Let's say there's two companies, okay? There's Daniel's company, which is company V, and there's Jeremiah's company, which is company F, okay? The way you manufacture your product is hourly workers, okay? Hourly workers, not salaried, but hourly. So if demand is high for your product and you need to produce a lot, you can just hire more people. Okay? If demand is low for your product and you need to produce less, you can send people home or lay them off. Okay? You, on the other hand, in your production company, instead of hiring hourly workers, you have invested in robotics. You took out a big old loan for all these robotics on your assembly line. And you owe roughly $50,000 a month to pay off the loan over the next few years for all these robotics. Now, these robotics are sweet. They can generate a lot of profit, and there are very little variable costs associated with it, except for your loan payment. Now, do you see, if times are bad and lean, Daniel is going to be in a better situation. Because you can send workers home, and your sales will decrease, but you can offset that effect by largely decreasing your variable costs as well. You, on the other hand, you still got to make that $100,000 fixed loan payment, don't you?
No, it was only 50.
Was it 50,000?
It was 50.
Okay, thank you. 50, 100,000, it's all the same. But not to lose the point of the story, you still have to make that loan payment of $50,000. Is that correct? Now, what if times get really, really good? He's better off because his costs are basically still the $50,000 loan payment on that machine, and man, you're just chucking this material out. You've got to keep hiring more people and paying more wages on an hourly basis, right? So you see how fixed cost company F, it's a lot wilder of a ride, isn't it? Okay? All right, if you take managerial accounting from me, you're going to see that this whole argument is a large part of the reason that manufacturing in the United States has outsourced overseas. Okay? Because they are, in essence, trading in a fixed cost for a variable cost, largely. And they don't want that wild ride. Okay? Not in these times. I'll talk about that in managerial if you take it from me. All right? Cool? We are done with chapter 21. We're done, except you have a Connect assignment. You folks at home, check your D2L calendar for the due date of that. Okay? So we are done with chapter 21, except for the Connect assignment that you will take. Okay? All right, any questions on chapter 21? What we're going to do now in these last 20 minutes is something that I have wanted to talk about, and I needed to find a time to do it, and we're going to do it now. So this is kind of a major switch of gears. Folks at home, if you want to take a break, this is a good time to go take a break. I'll have a nice, cool, refreshing sip of my orange LaCroix.
Orange liquor?
No, it's not liquor. All right? I drink that after the cameras stop rolling. I'm kidding. I do not. Okay? What we're going to talk about now is long-term notes payable. Now, why are we talking about, remember chapter 14 was on bonds? Why the heck did we wait until right now to talk about long-term notes payable? Well, I'm going to tell you. Once again, the reason is because I care about you as students. Here is the reason I do it. Because bonds and long-term notes payable operate very differently. And if I teach them both to you at the same time, it messes my students up. It plays with their brains, okay? So I like to separate them. And 7 chapters I've separated them. Go to this slide right here. How does a bond differ from the long-term liabilities I'm familiar with? Does anybody remember that slide a long time ago? Now, coming off of that, do you remember how a bond worked? All you did is every 6 months you paid interest. Nothing went towards principal. Your principal didn't reduce at all for the entire life of that bond. And then when the bond matured, you paid off all the principal at one time, right? So if we did a graph, principal stays the same until maturity date, and then boom. Do you remember that? Well, going back to the slide, long-term notes payable are different. They usually require monthly payments, okay? And the periodic payments go towards interest, but it also reduces principal. It also reduces principal over time. So if I drew a little graph up here, like for say your car loan, and this is your principal, it declines over time, doesn't it? Does that make sense? Now, I would not feel good as a teacher not teaching you long-term notes payable because this is something extremely applicable to your lives, is it not? You're going to have student loans, perhaps. You are going to have automobile loans, perhaps. And you're going to have a mortgage, perhaps, someday, right? And these are things applicable to your life, so I need to at least have a little discussion about this, I think. Okay? Plus, a business is going to have loans as well, right? Now, the discussion in your book on long-term notes payable, they simplify everything and they make it that you take out a loan and you make yearly payments. Well, how many loans do you only have to pay a payment every year? There's none, right? So I'm going to teach this to you that it more related to real life, okay? So, and the best way to do this, as I often say, is with an example, okay? So let's do one. On February 1, 2015, John Brosa decides to borrow $10,000 for his business, okay? Now, terms of the loan, 13 months. Thus, he will pay off in 13 monthly payments. Okay? You with me? And the first loan payment is due in 1 month on March the 1st. Okay? The annual interest rate is 12%. The annual interest rate is 12%. But we pay it off in monthly payments, don't we? So what is the monthly interest rate? It's 1%. You following me? So the question here is what will be the amount of John's monthly loan payment? That is the first question we need to ask ourselves. And what we need to do is we need to use our knowledge of time value of money, okay? Now don't freak out. I know it's been a while since you did time value of money, but we're just kind of going back into it for just a little bit here, okay? Here's what we got here. Before we come off this slide, let's define from this slide what is the I that we're going to use and what is the N that we're going to use in our time value of money analysis. What is the I that we're going to use? It's 1% because I'm asking about his monthly loan payment. So the interest rate is 1% per month. Okay? What does N equal? 13, because he's going to pay it off over 13 months. Is that correct? Okay, pretty easy how you solve for this loan payment. Okay? Let's go to the document camera. Okay, P equals A, P slash A, I, N. You remember that? Okay, go back to those time value monies if you don't. Okay, an annuity is a recurring cash flow of the same amount. Now, it says annuity, but that doesn't always need to mean annual. Okay? Now, we know our present value. The present value of this loan is $10,000. Okay? We're trying to figure out the recurring monthly payment he has to pay. We're going to go to our P of A table. You told me correctly that I equals 1%, and you told me correctly that N equals 13. Is that correct? So 10,000 equals A. We're going to go to the P of A table and look in column 1%, row N equals 13. And if I do that, here's our P of A table, table B3 on page B11. This is 1%. Row 13, I believe, equals 12.1337. Is that correct? Okay, so let me zoom out a little bit here. Okay, 10,000 equals A times 12.1337. Okay, thus our recurring payment equals 10,000 divided by 12.1337. And I believe that equals $824.15. Did anybody else get that? First of all, ask yourself, is that a reasonable amount? Yes, it is. Now, if you would have got a monthly payment of $63,000, that's not reasonable. If you'd got a monthly payment amount of 74 cents, that's not reasonable. Okay? So always make sure you're dealing in a reasonable amount. Okay? So that's how much John has to pay. Are you with me? Now let's switch over back to the computer. All right? Okay? So our principal amount is $10,000, right? Our term of the loan is 13. The annual interest rate is 12%. The monthly interest rate is 1%. Is that correct? And we figured out the monthly payment previously is $824.15. Okay? Now what I'm going to do, and this is just a very important piece of knowledge that you should have in your lives, both for your personal use and your business use, is an amortization table. Okay? Now, the headings of the amortization table are as follows. Date, the total payment amount, the amount of that payment that goes to interest, the amount that goes to principal reduction, and the ending balance of the principal. Okay? Now, sometimes what we like to say is, this is the purchase date, February 1st, right? Okay, so we don't fill anything in here, okay, except for the loan principal amount of $10,000, okay? Sometimes we say that's time period 0. That's the day we take the loan, correct? So let's go ahead and make the journal entry for that date. The journal entry on February 1st, the date of the loan, is we debit cash for $10,000 and we credit notes payable for $10,000. Is that correct? You with me? Okay, now let's figure out how to fill in this table for March 1st. Sometimes I say that's time period 1, because that's 1 month from now. Okay, well, what is our total payment amount that we calculated? It's $824.15. Is that correct? Now, how much of that goes to interest? This is what I want you to concentrate on. This cell right here. The way we calculate this is we take the most recent ending balance of principal, which in this case is $10,000, times the monthly interest rate, which is 1%, right? Well, we can do that in our head. What's 1% of 10,000?
100.
It's $100. So of this $824.15, the first thing it needed to do was pay the interest charges. Now, the remainder goes to actually reducing principal, okay? The remainder goes to actually reducing principal. So this $724.15 is our total payment of $824.15 minus the interest charge, and that is $724.15. So what does our principal reduce to? Well, do you see it would be this amount minus the $724.15? And it has now gone to $9275.85. Are you with me? You see how we did that? Well, what if we make the journal entry for March 1st? Well, we paid out cash at $824.15. How much do we debit interest expense for? $100. And how much do we debit notes payable or reduce notes payable by? $724.15. You need to have one of these amortization tables to make this journal entry, okay? And a lot of times, the bank will give you an amortization table to help you with this. But I did this on Excel, okay? I did this on Excel. It's pretty easy to do if you know Excel. Any questions on that March 1st rationale? Okay. What about 2 months from now, on April 1st? Well, our total monthly payment is $824.15. As a matter of fact, our monthly payment is always $824.15, correct? No matter what the date, okay? Well, how much of the April 1st amount of $824.15 goes to interest? Once again, you take the most recent ending balance of principal times 1%. So that would be 9275.85 times 1%. Is that correct? And that equals 9276. Well, how much goes to principal reduction? That minus that, 731.69. Now to compute this cell, we take the most recent balance of principal minus the balance of, or the principal reduction amount of 731.39, and our balance is now 8544.46. Are you with me? Okay. Questions on that? This is so important. Now, if you fill in, first of all, notice that as time goes by, our interest charge is less, isn't it? Because our balance of principal is going down. And interest is based on how much you owe, your principal balance, right? So there's more going towards principal reduction from that payment as time goes by. Is that correct? If we fill in the rest of this table using the same rationale, this is what you get. Now, by golly, by gum, that should be, oops, that's not the one. This should be 0, shouldn't it? Because that's 13 months from now, the ending balance is 0. Does that make sense? And if you do totals, you can see, what do you think this column should equal? The amount of principal reduction broken down by month. Don't you think it should equal 10,000? Whoops, again, the wrong cell there. Okay? It should equal 10,000, right? Because that's the amount up here. Does that make sense? So the total of that should be 10,000, okay? Now, if you total these columns up, you can see that 13 times 824.15 is 10,713.93. Thus, we paid total interest charges for that loan of $713.93. You with me? Okay, let's go back. Can we make the journal entry for April 1st? Let's do one more journal entry. Yeah, we can. Well, our total payment, and again, we're looking at April 1st here, okay? What was our total payment of cash? $824.15. How much of that went to interest expense? $92.76, right? And then the remainder went to principal reduction, $731.39. There it is right there. Cool? Now this is powerful, and I'm going to tell you why it's powerful. Number one, look at this. Do you see where and I'm not going to go through it all, I'm just going to touch on it. But do you see if you upped your total payment amount, how that would, your interest amount would be the same to start out with, but your amount towards principal reduction, your extra principal payment would all go towards principal reduction. Do you see that? And you could decrease this, thus this next interest expense and all the interest expenses after that would be less because your balance of principal is declining quicker. Now you may say that's not that big of a deal. Well, come off that for a second. If you have a $200,000 mortgage someday for a home and you're paying it off over 30 years, let's say your total loan payment is, I'm just making up a number, I have no idea. Let's just say it's $1,500. Well, what you're going to find is like the first 8 or 9 years of your mortgage, of your $1,500 monthly payment, hardly any goes to principal reduction. Maybe $40 or $45. So if you can pay an extra $45 on top of your monthly payment, just an extra $45, it will pay off twice the amount of principal for that 1 month. Does that make sense? You can save tens of thousands of dollars by making small extra payments on your loans. Now, I feel like I was beholden to share this because paying off debt is such an important thing, right? Okay, and you don't want to have debt crippling you. And I know some of you are going to leave class or leave your, after you get your degree, you're going to have school debt. Paying off or paying a little bit above your required payment can make that principal reduction go down. You can cut off years off your mortgage and save tens of thousands of dollars. Now, obviously, the effect is greater for a 30-year mortgage as opposed to a 13-month loan. And obviously, the effect is greater the higher the interest rate, right? But please be aware of this. This is a very powerful concept, okay? All right, any questions on that? I wanted to make sure we don't have many more lectures together, okay? We're in the single digits. I don't know how many we have left, but it's in the single digits. I wanted to make sure I went through this. But do you see why that I didn't want to teach at the same time as bonds? Because bonds are also a long-term liability, but they are so different. And it usually messes with students' minds if I teach those in the same chapter at the same time. So I wanted to get all this separation. Cool? All righty. I only want you to do one thing for homework. And did I hand that out there? Yeah. Can I show the people at home what that looks like? All right. The only homework I want you to do is this automobile note payable handout. Now, this is 2 pages. So make sure you do both pages of this, okay? The other thing that I want you to notice is that you need to use the time value of money table. This is the P of A table on the second page. You need to use the table I give you, okay? We'll talk about why you needed to use this table as opposed to the one in your book. We'll talk about that next class period. But the only homework you have is to do both pages of that automobile note payable handout. Yes, thank you, Luke. And I also want you to do your Chapter 21 Connect. Next class period, we'll go over this automobile loan payment homework, but then what we're going to start is in Chapter 22 on budgeting. Make sure you have your calculators, okay? Hey, we're getting to the end, guys. We're getting to the end, all right? Hang in there. We'll see you later. Bye-bye.